Bourque with Glovista Investments. This week we focus on the gold miners, a sector where we believe the macro backdrop should remain favorable. Carlos Zillis maintains his bullish view on precious metals prices based on his outlook for US dollar weakness and low real interest rates. Now, so far this year, gold mining equities have largely outperformed gold prices, particularly during the period of gold's trough in March to its peak in August. Now, looking at the second half of the year, the outlook for the sector's earnings and cash flow is relatively solid based on the gold price tailwind, the expectation of some production improvement sequentially, as well as lower costs. Now, aside from the gold price tailwind, it is important to look at some of the dynamics in the sector in terms of investing in it. One certainly has been the challenge of discovering meaningful new gold reserves. Here, CapEx requirements are extremely high. Reserves are difficult to find, and the lead time between discovery and actual production is very long. For that reason, M&A has been an important growth strategy in this sector. However, the track record here has been somewhat mixed. Also, I would mention just the new technologies that are available. The sector has been somewhat slow to adapt them, but I do think they could have some positive effect going forward in terms of organic growth, and some of the larger, well-capitalized companies are in a good position to take advantage of this. Now, in terms of valuation drivers, I would cite asset quality, shareholder return potential, production prospects, and most importantly, the strength of the balance sheet and strong free cash flow, which certainly serves as a cornerstone for those first three parameters. Now, when you look at the two industry leaders, Newmont and Barrick, they do command valuation premiums since they score strongly on those four metrics. However, even with that premium, I do like both stocks with a slight preference for Newmont. When you look at the other gold majors, as well as some of the small mid-cap players in gold, here the re-rating potential could be stronger. However, to the extent that some of those companies maintain reserves in higher risk regions or have balance sheets that are less strong, they may be less resilient in a lower gold price environment. For that reason, I do like the GTX ETF as a way to get exposure to the gold sector. Here you have Barrick and Newmont, as well as an attractive array of North American, Australian, and South African gold companies, as well as the two streaming companies, which I like. Thanks for listening.